Hello everyone. Look, Tony and I are here to answer some of your questions that you have posed to Tony via Tony's Thoughts or Tea with Tony. So thank you for contributing. Now look, you're not a financial advisor, and I always say this, but I'm going to ask it anyway and see what you say. But this one's about digital currencies. I would like to know your stance on the failing of the fiat currency. Also, the Reserve Bank's proposal in September 2021 removing to a digital currency. So that's a bit more kind of pan and Reserve Bank. I don't know anything about that. I'm interested.
Yeah, okay. I'm not sure what the person means by failure of the fiat currency. I look around the world and still see massive demand for the United States dollar. Kiwi dollar is well supported. So if that's what you mean by fiat currency, I see zero evidence of failure in that regard. The Reserve Bank, like other central banks, will move extremely cautiously with regard to developing their own digital currencies. The number one consideration will be that they still retain control of the flow of money overall in the economy, that when they need to tighten monetary policy, they are able to do so to influence the price for that digital currency, which means interest rates applying to loans, etc., and assets held in that digital currency. But I think people need to curb their enthusiasm for the speed with which this will happen from central banks. It's not going to be immediate. The last thing they want to do is create a new sort of monetary system there and it collapses, and that's the sort of thing which can generate really bad outcomes.
What is the hardest or most humbling lesson you have learned as an independent economist? And if there is one piece of advice you could give a young businessman or woman in today's economic environment, what would it be? And that's actually quite relevant because you went out on your own and set up your own business, and it was actually a very brave thing to do. So talk us through that, Tony.
Yeah, I don't know about lessons as an independent economist. What I've learned, and I wrote about this in my Tony's View Weekly 2 or 3 weeks ago, one of my big learnings many years ago was make sure my view is not overly influenced by others. Make sure I receive diversity of opinion and don't end up too much with voices of the business sector coming in towards me, because that can lead me to say things which maybe I don't necessarily believe, and strip all the emotion out of it, essentially. And I'm sort of referring back to some events in 2000 when I was impolite to the finance minister, Sir Michael Cullen, at the time, and the business sector was too much influencing me. So that I suppose was maybe my most humbling experience, basically. Make sure my views are independent. And for the average sort of business person out there, anticipate things are going to change. There is no stability. When you are starting up a business, you have to explicitly look at yourself in the mirror and say, I am accepting the challenge of the massive uncertainties that I am going to face. And I've always said this about farmers, for instance. They don't set out, I'm going to be a farmer, I'm going to grow carrots, and that's it. They know they are taking on the challenge of they can't predict the prices of the carrots or the carrot seeds, if that's what they're making. They don't know what the weather's going to be. They don't know how trade restrictions overseas are going to change. They don't know what the pests and diseases are going to be that are going to come along, but they accept the challenge of adapting to changes in conditions as they come along. So when you're setting up your business, maximize not only your sort of strategy and how to win from that, but also your ability to adapt when the changes come along, because they most definitely will.
Yeah, no, look, great advice. And the bit about being a free thinker, an independent thinker, and listening to multiple viewpoints, I think that's really relevant, particularly across the board for people that aren't just business people, but everyday Kiwis. Why does the government, and you may not be able to answer this, why does the government add cost upon cost, regulation upon regulation, inflationary measure upon inflationary measure, which is a fair point, and then complain when the prices go up, asking for a friend?
Yeah, asking for a friend. Yeah, okay. A Labor government has zero understanding of how businesses function. We're not talking about people who have run businesses. We're talking about people who have probably spent their entire careers working in the public service. They've been unionists, community workers, teachers, and academics. And their focus is not on achieving maximum economic growth, not on achieving, maximum business profitability and growth, etc. It's essentially on changes in society, many of which I'd suggest most of us would agree with, quite frankly. But they do it in ignorance of what the actual impact would be on the business sector, and also without taking into account what the impact is going to be on the average family's cost of living by putting in place regional fuel taxes and these sort of things. And much as the finance minister in a Labor government is given responsibility of basically make sure the economy doesn't collapse while we're going through with our changes, there could, I think, be greater insight given to the cabinet ministers from the likes of the finance minister, commerce minister, etc., about what the real impact is going to be on family households and businesses out there. But unfortunately, history shows that Labor governments remain sort of unlistening to the business sector, unfortunately, until the very end. And then in order to maybe cover up some of the effects they've had out there, they let loose the fiscal spigots in the last year when they are in government, and often leave a little bit of a fiscal mess for National to pick up with. But let me even that out. Remember, I said balanced viewpoints, etc. It's not generally as if National come in there and radically change the economy necessarily for the better, because the party of change in New Zealand is the Labour Party. And the things for which we Kiwis are maybe most proud of often come from the Labor Party as well. So I like to think, social changes. We're in New Zealand because we like the society and we like the lifestyle here, not because we think, ooh, if I'm in New Zealand, I'm going to make $1 billion. No, if that's your thinking, maybe you should be in Singapore.
Yeah, and I think it's always, the answer is always somewhere in between. But yeah, I think it was a great answer. Thanks, Tony. Now, look, this one is a little specific and it pertains, but it's a chap called Mahesh, and he's asking about back my build rate, which is floating, and I think we've kind of answered it in Tea with Tony this month, but he's saying that, asking for a friend again, he can get a back my build floating rate of 2.6 for 3 years on his first home. I'm not sure if that actually rings for you, if you know anything about that, because I don't. And I don't think you're sanctioned to give personal advice. So we just need to be really careful. Maybe some general guidance around floating and fixed rates like we've discussed earlier today.
Yeah, I think whatever the deal is you're getting from a lending institution, we've got a special deal for you because you're doing a certain thing. Be careful in your assumptions about how long the deal will last. Be careful about over extrapolating into the future, thinking you always get that discounted rate, even when your place is built, even if you're still paying the mortgage off in 5, 10, 15, 20 years later. So definitely have a look at your assumption about how long you keep a discounted rate from a lending institution for whatever your special category is there. And if we get there for the Reserve Bank, let's say, increasing the cash rate another 2% from the 1% it's at the moment to 3%, then all of us economists are going to say you should allow for your floating mortgage rates going up 2% from where they are now to where they're going to be in the second half of 2023. It's just going to be a different level from someone who's currently paying 4.5%, ends up maybe 6.5%. If you're paying 2.5%, you're going to end up maybe 4.5%.
So this is a CCCFA question. We talked about this in Tony's Tea with Tony previously, but is it likely the government will review and amend the legislation anytime soon in relation to CCCFA, as the consequences have made it impossible for a large majority of New Zealanders to get home loans approved? I'm not sure if I know it's not impossible for the majority, because otherwise we wouldn't be in business, is the truth, but it is certainly, there's been a tightening and, as you call it, a bit of a credit crunch, and it has been difficult. And he said, do you know if, or he or she has said, do you know if there are any discussions happening? And we know some are happening, don't we?
Yep, definitely a review is being undertaken by a number of sort of regulatory lending authorities out there of the legislation. And so there will be some tweaking, but we simply cannot know the extent or the timetable of that tweaking. My personal view is that the impact of the CCCFA-induced credit crunch is at the moment, because you've got a whole generation of young borrowers in particular who have become used to credit being, pretty readily available, the bigger problem being getting the deposit together, etc., are now being told, well, although you say you're going to cut back on spending $100 a week on coffee, we can't believe you. We have to look at what your spending behaviour has been, and we have to assume as a lender that's what it's going to be going forward. And so I had the example given to me by a mortgage advisor recently of the lender was inquiring, you went for a bungee jump in Queenstown there
So
eight months ago. How often do you go bungee jumping? Well, the bank can't assume it's a once in a lifetime experience. They sort of have to factor it into your expenses going forward. And like I say, at the moment, I think a lot of people are cutting back on their spending so they can build up 3 to 4 months of proof that they don't have to keep spending $100 a week on, clothing, $500 a month on new shoes. Attractive as all of this is, that prove that they can sacrifice.
When you say that, so I saw you lean forward.
I'm assuming there's some big cupboards there with shoes. So I think it's the worst at the moment. Things will alleviate a few months down the track, but exact timing, magnitude of the backtracking on CCCFA, I don't know. We've got to wait and see.
Yeah, with the review they're doing, and hopefully they have some nice friendly discussions, and there's some practical outcomes, logical outcomes that come out of that. Okay, so this is an interesting one, and I think you'll be able to add really good context and explanation here. So the question from the person is, do you think banks are double dipping on interest rate rises?
Don't know what that would mean, but I'm going to assume it means that the official cash rate goes up, 90-day bank bill yields, etc., wholesale funding costs go up, and so logically banks increase their mortgage rates. That is exactly the intention of the Reserve Bank. If the Reserve Bank tightened monetary policy, increased the cash rate, and banks didn't change their lending rates, there is no tightening of monetary policy. The tightening comes from the mortgage rates going up. So, yep, mortgage rates are going up. Many people are observing, but the deposit rates are either not going up, or they're going up more slowly, or they're not going up by the full 0.25, 0.5%. And yes, that is what's happening. Why is it that the banks aren't aggressively increasing their term deposit rates? Because they are awash with money. The Reserve Bank has bought $55 billion worth of local central government bonds over the past 2 years, explicitly to make sure banks are awash with money, that they have all the funding that they need in order to keep on lending out there to the housing sector, to the business sector, as they have done pretty well over the past couple of years. So banks do not need to compete aggressively for our deposits. And so it's going to continue to be the case through the coming 12 to 15 months, maybe, that the increase in term deposit rates will be less than the increase in bank mortgage rates, quite frankly. So that's probably what they are referring to, because certainly other people have asked me the same thing.
That's an interesting point. I think what they meant is when the OCR moves and the banks put the interest rates up, they're adding margin in. I wondered if that was what they were meaning with the question. But they from what you tell me, they factor in a lot of different factors when they do that, don't they?
Okay, yeah, well, so far the increase in bank floating rates about matches the 0.25% increase in the sort of their floating rate costs out there. The fixed interest rates, now that's where the banks compete against each other. When fixed mortgage rates appeared in New Zealand from about 1990, 1991, banks chose to compete for new customers with discounted fixed mortgage rates. And it led to the likes of the average margin for a bank lending on fixed rates settling at around, 1.2% or something, which is about half of the margin banks were getting on floating rates. In Australia, different dynamic. When fixed interest rates appeared over there, the banks went, meh. And they keep competing for business by discounting floating mortgage rates. So this is something quite specific to New Zealand. Now, the fixed mortgage rates, the cost to a bank of lending there is influenced not just by the cash rates the Reserve Bank sets, but also overseas interest rates for the 1, 3, 5 year periods. And I have a look each week in my TView Premium weekly publication at a set of graphs where I actually track the margin for bank lending at the fixed rate terms, 1, 2, 3, 4, 5. The margins are well below average at the moment. Fixed interest rates from banks are likely to increase more than the official cash rate is going to be increasing for some of the terms in the very near future, or more specifically, more from the bank increase in the cost of borrowing 1 to 3 year to lend out fixed. So there's more fixed interest rate increases to come, and bank fixed mortgage rates at the moment are actually below average. There's margin rebuild still to come.
Oh, that's really insightful, actually, Tony, and people understanding. It's really good to assume. People assume these things about banks, and that's really good background. So thank you. When will, I'm not going to get you to answer this one because I'm going to draw them back to tea with Tony. When will inflation stabilise? Tony and I talk about this at length in Tea with Tony, so I'm going to send you off to that. It's a very difficult question to answer, but Tony's actually got some excellent guidance. So is there any, without giving it away, Tony, any other guidance you'll give? Go and see Tea with Tony is my guidance there.
Yeah, inflation never stays high. People over extrapolate. It always settles back down again. The oil prices go up. At some stage, they'll come back down again. So, yeah, these are going to be interesting things for 2023.
And then another one which is really well answered in Tea with Tony, but I'm going to let you answer this one as well. So does Tony believe house prices will fall?
Yes, they've already fallen on average 1.5% in December and 1.1% in January. So what's that, 2.6% so far? There might be another 7.5% worth of declines. And if they fall 10% overall from the peak in November last year, that will take prices back to, oh, God forbid, June of last year. And even if they go down by 20%, it's only going to take them back to December of 2020. I don't think the declines will be 20% on average, but it's best to think of a lot of what happened in 2021. Well, that wasn't real, was it? The soaring prices. I think just sort of look through a little bit of that and you can help put in perspective the retracement of house prices more towards sort of realistic levels through this year.
We do cover that really well in Tea with Tony and both provide a bit of guidance around, not panicking and not listening to too much to the nasty headlines and navigating your way through and getting some really good advice like what NZHL can give you or other mortgage consultants. There is a way through. And you would have been given the lending because generally you can afford it. So, look, Tony, it's always a pleasure and it's great to see these questions coming in from viewers. So thank you very much. Tony's views are his own. He is an independent economist. And thank you very much.
Thanks, everybody. Bye-bye.